the internal mic here. And with this particular one, just to make sure I know what mic's working, because there's nothing, yeah, okay, good, our mic is working. There's nothing worse than thinking you're recording something and you're not. This particular one, and we had worked this towards the end of class last time, they wanted us to figure out the budgeted cash collections. And remember, we consider our cash collections off of our sales, right? And so the way we solve this, since they were asking us for June, and remember we said that most of these problems are reading comprehension problems, right? For the most part, that's really more what we're testing than anything. And so since we were dealing with June, and they tell us that the June sales were 110,000, and the problem told us that they collect 25% of the sales in the month of the sale, we simply picked up the June, we multiplied that times 25%, right? Then they told us up in the fact pattern that, and I forgot my little external mouse, of course, that the May sales were 100,000, and they tell us 65% is the month following the sale. So the May sales, at least 65%, will be collected in June, right? So they took the 100,000 times 65%. That gave us the amount that was going to be collected of May sales in June. And then they tell us for this last one, the April situation, that what, 5% in the second month following the sale. So if we have what, June that we're talking about, what, June is the second month after April, right? May, June, okay? So we go ahead and we pick up 5% of the April sales of 120,000 in June, and we go ahead and do the multiplication on that. That gives us the 6,000. Okay, so the answer is 98,500 here, and you know that I told you last time that some people, some students struggle with that 5%. They say, "I'm supposed to subtract the 5%." No, you're simply not supposed to collect it, right? You don't subtract it, but you obviously don't collect it. So you almost ignore that, right? Okay. Okay, good. Any question on that particular one? Okay, good. So with that, oh, we did this one too, didn't we? We did this raw materials one. So why don't we just go ahead and, do we do this one? What did we do, practice the whole homework last time? Okay. Any question on any of these? I think this was the one where I did the 60% at the end, right? Okay. Okay, good. How about... There we go. I don't think we did this one, right? Okay. So they want us to figure out that the raw materials, purchase of raw materials to be budgeted for the month of February, right? Okay. So who wants to help me out on this one? You can help me on this one. So they're looking for February, right? Yes. And so the question becomes, how much material do I need to meet my February production budget?
You should have 20% of January's already there, right?
20% of January's, as a beginning balance, you mean?
Yes.
I'm thinking as a beginning balance, I should have 20% of February's, right?
Right.
Not January's?
Oh, yeah, sorry.
Yeah. So 19,000, right? And it's 19,000 because they tell me that it takes 1 unit of raw material to produce 1 unit of product. And so even though they're giving to me this in units, I don't have to really do anything to convert materials, number of units of material to number of units of product, right? Okay, so it's
38,000.
19,000 times the 20%, 0.2, gives me 3,800, you mean, right?
3,800.
Okay, good.
And,
That's the beginning balance, right?
yes.
Do I need to produce some,
And we also have to have 20% of 18,000 for the month.
okay, 20% of next month is what we have to have available, okay?
Which is 3,600.
Okay, 19,000 times 18,000, right? Times 0.20 is going to be 3,600. So we got the beginning, we got the ending, right?
And then we also add 19,000 for February.
Okay, so how about if I do this? I'm going to write over here that we know we need 19,000, right? For February on a 1-for-1. And we know we got to end up with what, this 36? Okay, so I'm going to go ahead and I'm going to add the desired, I call it the desired, the book does too, the desired ending inventory of what? You tell me it's 3,600?
Yes.
Okay, good. So that gives me a total needs here of 22,600. Okay, good. And then what? I had a beginning balance
Yes,
minus the beginning balance that I should have had in 3,800 to start out February with, right? So does that give me this 18,800? Right? And that's the way they did it down here. I like to set them up like this. Sometimes I disagree with the book setup of these. For this one, I like their setup because it's logical to me to think of it that way. Okay. Question? Good job. Okay, good. How about this one we had done, right? This Milano, okay? And the only thing that we need, these labor problems are pretty easy because it's simply what? The number of units times however many or fraction thereof of direct labor. I don't think I can touch the screen either and no mouse. So we're going to have fun with this today. The number of units that we're going to produce what do we have in fireworks up there? Okay, so it's going to be the number of units that we're going to produce. Wow, I didn't realize what a difference that mouse makes. Okay, the number of units that we're going to produce times the number of hours needed, and they tell us here that it's what, half an hour per of direct labor hour per item, okay, and then they tell us that we're using going to produce 6,400 units, and these 6,400 units, and so we simply have to apply the half hour to those, right? Now for some of these, they give us a minimum guaranteed number of hours that the employees are going to have, and so if the guaranteed is more than the needed, then we pick up the guaranteed, right? Whichever's bigger, the guarantee or the actual needed. But in this one, there was no differential there, so we just simply went ahead and picked up the hours they gave us times the 0.5 times the direct labor rate, and that gave us what we were going to need for labor, right? Okay. We get a musical entertainment, right? Did we do Maury? Did we? And the only thing with Maury was that, they had labor hours that were less than the minimum? That was the only thing that was interested about that, so that we picked up the minimum labor hours, because they were more? Okay, if the needed had been more, we would have picked up that. Now I remember I say they should have had it where at least one of them, the needed was more than the minimum, then we could have seen both things in that one problem, right? Okay. Okay, good. So I think now we're finally getting to some in which we had to do a little work on our own, right? Oh, I don't like this one. I'll show you this one. I stuck this one in here by accident, in that they were asking for the predetermined manufacturing overhead rate, which we learned back in chat, or maybe I put it in there just to remind you how we did the predetermined manufacturing overhead rate, but it's not relevant to what we're studying here in chapter, what is this, chapter 7? And that we already know how to do the predetermined manufacturing overhead, which is to take the total estimated amount of overhead divided by what? The estimated driver, which was direct labor hours, and that gives us a rate per direct labor hour, whatever. Okay, and that's how we apply the overhead. So that was just a review of that. Is that Beyonce? Okay. Let's go over and let's take a look at this next one. And so what are they asking us for now? The selling and administrative expense budget? Okay, so who wants to set this one up? You want to set it up? You want to come up and do it, or you want to do it from there? Huh? Do it. Well, that would be really good if you could make it appear on the screen from here, but I'll write it as you tell me as best I can, okay? So they tell us it's 4,800 units?
Yeah.
Okay.
And then it also tells us that we have a variable expense for selling administrator at $8.10 per unit.
Okay, so you want to multiply that times 810 then?
Yeah.
Okay, good.
Then that gives us our variable expense of 38,800.
Say again?
38,880.
38,880, you say?
Yeah.
Okay.
And then we got a total selling administrator. We have to add our fixed selling administrator.
Okay.
It says that is 71,520.
Okay, good. So you pick up the fixed, 71,520. Good. And that gave you a total there, or?
Then it gives us
1.
10,400.
Why is that not sounding right to me in my head? Huh?
38,000.
Oh, it's 38,000. Okay.
38,000.
Okay. 110 what?
400.
400. Okay, good. Okay.
And that gives us our total selling administrative expenses.
Right.
Now, it also tells us that we have to account for our depreciation.
Depreciation's a non-cash, and we're trying to come up with a cash budget, right?
Yes.
Okay. So you want to subtract that out?
Yeah, and it tells us that depreciation is 16,800 per month.
Okay, good. So we're going to subtract out that depreciation, because depreciation we've known now for a long, long time. Remember when you first studied depreciation, you were like, well, what? And now look how easy that is for you. You know that depreciation doesn't include any cash, right?
Yes.
Okay, so now I'm down here. I'll just Let's just roll with it. So we are subtracting out that 16,800.
And that gives us a total of 93,600.
93,600 of cash is going to be spent on selling and administrative, right?
Yes.
Good. And that was D. So we just kind of jumped down here for our calculations. The screen decided to jump for us. Okay, good. Thank you. Okay, so what do we got here? Now we're getting interesting. They want to figure out how much the company needs to borrow here, right? Okay, so must be that they're going to compare their cash receipts to the cash disbursements. Now, when we do our sales budget, and that jumps us to our cash receipts, and then we look at our what? We're looking at our labor disbursements, our material disbursements, our overhead disbursements, both for manufacturing, and then we look at it for manufacturing, and then we look at our selling and administrative, which I think you notice the calculations for selling and administrative and the overhead are a very similar sort of algorithm there. Okay, and so once we have our receipts and our disbursements, now we can figure out if we're going to have any borrowing needs, right? Okay, so this problem doesn't make us go through all those pre-steps to get to the amount that we need to borrow. They just tell us, here's the disbursements, here's the receipts, right? And we're going to see if we have a cash shortage or not, and if we do, we're going to need to borrow, right? Okay, so who wants to set this one up? This gentleman beat you to the punch. What's your name again, sir?
Rizwan.
Rizwan, you want to try this one?
Sure. So, it's asking for borrowing.
Right. Trying to get the borrowing.
So we can start with beginning cash balance.
Okay, good. So we got a beginning cash balance, what, 45,000?
Yeah.
Okay.
And then we gotta add the cash receipts.
Good. We got cash receipts here, so we're not going to have to borrow that money, right?
Yeah.
Okay, good. So we add in the cash receipts.
And with that, you get 174,000.
Okay.
And then that's total cash. Then subtract the cash disbursements.
Good. So the problem gave us cash disbursements of 124.
Yeah.
Okay, so we're going to subtract those.
And then you get 50,000.
So we got 50,000 cash, and the problem tells us we want to end up with what? 60,000? Okay, so I just like to do a little side calculation myself rather than put it all sort of in one table, because it just feels more intuitive to say, well, if I need 60 and I'm going to have to do what? End up with 50, right? Then I need 10, don't I? I just always like to do the little side calculation once I figure out what the cash surplus or shortage is going to be, and then versus the needs, and that just keeps me from. You try to do it all like this, I feel like you start. I don't know. I start staring at those tables at the bottom. I'm like, what did they do down here? So I find it a little easier just to kind of do a little side calculation. Okay, good. Who would ask me for some more homework problems? Somebody sent me an email, said, more homework, please. Huh? 6 is harder than 7. That variables versus absorption, blah, blah. Like I said when I was telling you guys, if it was up to me, I wouldn't even test you on it, because it's like nobody walks around saying, hey, did you hear the one about variables versus absorption? You know, whereas somebody might actually talk to you about this at some point in time, you know, later on in your. So I believe in this chapter. I don't particularly believe in the other one. But don't worry, guys. We're going to end up in good shape to have plenty of time to go back over everything prior to our final. Our timing in this class. A lot of my classes I struggle to fit everything in. In this class, you guys are sort of just soaking it up as we go along. So we're going to have plenty of time to go back over and practice, and we'll make sure that the practice finals are heavy on that stuff, so that it starts to become almost second nature to you, so that you can forget it on December. When's our final? 12th? So you can forget it on December 15th, whatever the last day of class is, whatever the first or the 17th. I forget when our final is, but whatever day it is, you'll forget that stuff the next day. And if you don't, come talk to me. I can put you under hypnosis so that you'll forget it. No, I can't. I'm just kidding. Okay. You never heard of variables cost. Okay, who wants to do this next one? He had asked on the list. We'll get you. We're going to do some for the next chapter.
So you can just set it up.
Oh, sorry.
Oh,
You guys want to arm wrestle? You got to watch these Raider fans, man. They'll take advantage if you give them a chance.
so you can just set it up in your base formula. Your beginning is the 41,000.
Oh, okay. You're going to use base. Okay.
Yeah.
So we've got 41,000 as the beginning. Good.
Yeah. And then you add in the 114,000.
114,000 is the add. That's the receipts.
Yes.
Okay.
And then you subtract the disbursements, which is 113,000.
Subtract the expense, which is what? 113.
113,000.
Okay.
And then that gives you an ending of 42,000.
42,000.
And then since you're not looking to borrow, you don't have to calculate that. It's just looking for the excess deficiency of cash. So.
And so you ended up with 42,000 is the answer.
Yeah.
Okay. Good. What was your name again, sir?
Jay.
Huh?
I'm Jay.
Jay. Elliot. I'm going to ask you to play jazz with this one, okay? Let's say they said they wanted 60,000 in cash at the end. What would you do?
Subtract 60,000 from 42,000.
Yeah, well, okay. I set it up like this, but you could do it however you want. 60, but you could do it either way. 60,000 is what they want at the end, right? And 42,000 is what they got, right? So we want to borrow how much? 18. Okay, good. Okay. Okay, good. Question? Is that it? Okay, good. So, let me go ahead and save this. What is that, a film appreciation class? Good thing they're not watching Pulp Fiction. We'd have to ask them to turn it down. Okay. Okay, so let's go ahead and let's take a look at the slides from chapter 8 now, right? Was everybody able to find those on Canvas? For change, I hit publish. And you're able to get those off of Canvas?
Is it under modules?
Yeah, everything's under modules. Each week go to the modules, and that's where the chapters are, and everything's listed by chapters. It was there? Okay. Okay, good. So, I want to go to class slides. What is it, chapter 8? I made a small tweak to that this morning, but it's not a big deal. Okay, so we're going to go through the slides here. Well, it's too soon for a break. If we need to in the middle of the slides, we'll take a break. Then we'll go through a couple of the homework questions. I'm going to have to sit a little closer to the computer. I don't like to, but I'm kind of forced to because the my external mic's not working. So let's go ahead and let's take a look at flexible budgets and performance analysis. So we understand now how we develop the budget, right? Starting with the sales budget, etc., cash receipts, cash disbursements, setting up our budgeted financial statements, and then we're going to track against the performance against that budget. Now, what happens? When we were preparing the budgets, we had a certain level of activity that we anticipated, didn't we? Okay? And so if we compare our performance to the budgeted level of activity, that's going to give us a static budget that is only useful or most useful only at what? At that level of activity. But of course, our level of activity will vary, obviously, right? I mean, you can plan all day long. What do they say? Man plans and God laughs, right? And we don't end up necessarily doing things the way we plan. So what we're going to learn is that we're going to be able to set up something called a flexible budget. And what this flexible budget is going to allow us to do, it's going to allow us to plug in the actual level of activity and still be able to compare to our budgeted figures, and that's going to give us a more meaningful analysis than if we had just used the budgeted level of activity. We call that flexible budgeting. That's sort of the first half of the discussion, and then we're going to jump into a second half of our discussion in which we're literally going to understand why we have varied from our budget. And we're going to see that there are two reasons that we vary from our budget. One is the price of the items we use, and what are our factors that we use? Our product cost, our costs for the period are going to be what? Going to be materials, going to be what? Labor, and going to be our manufacturing overhead. One is the price, and one is the amount of that input that we use, okay? So we'll literally be able to break down our spending variances at whatever level of activity by looking at both price and what? And quantity of those inputs that we use to manufacture our goods for the period. And by doing that, the company is in much better position now to do what? To attack the underlying causes, the root causes of the problems, get to those, and when we get into some of the later chapters, we'll start talking about how we'll assign responsibility for those various aspects. And so we'll be looking at our purchasing manager versus our production manager. And we'll know that it is, hey, purchasing manager, you didn't perform up to your expectations. Please, take the corrective action, whatever it is. And they call that responsibility accounting, okay? And we'll get into that in some of our later chapters, okay? Okay, so that's just where we're going with this stuff. And that's really what this cycle represents here, in which you have your budgets, and then you go ahead and you perform your variance analysis, and then you compare the variance, the actual to the variance, to the budget, I should say. That gives us our variance analysis, and that leads to questions, understanding the root causes, taking corrective actions. Maybe the purchasing manager says, well, look, we had this vendor that used to be very favorable to us, and they went out of business. Well, maybe we need to negotiate some sort of deal with a new vendor or something like that. Or our old deal ended, and I've been having to go month to month because somebody upstairs hasn't negotiated the new rates for us or something. Whatever, right? But it allows us to get down to the root causes, take corrective actions, and then, again, start to compare the actual to the budget, etc. And we're just doing this continuously. And we probably would do something like this at a minimum on a quarterly basis, depending on the nature of the company. We could do this monthly, every 6 months, once a year, whatever. Okay? Okay, so we come over and let's just talk about the notion of a flexible budget versus a static budget. static budget is only good at one level of activity, that planned level of activity. The problem with the static budget is that actual level of activity is rarely the what? Rarely the budgeted level of activity. And so you start having distortion in that you're comparing, and they're doing this little apples to oranges thing, you're comparing apples to oranges because you're comparing one level of activity, the budgeted, to the other level of activity, the actual. And so we're going to see that flexible budgets will help us around this problem. But just to, well, we'll take a look at how flexible budgets are going to help us around the problem that I just described, and they'll show the cost that should have been incurred at the actual level of activity, and so we'll be comparing apples to apples. Okay? So let's just go ahead and take a look at this Larry the lawn guy's example here. And Larry determines that he'll mow 500 lawns a month, and he used his May budget to prepare his June budget, his May activity to prepare his June activity, to prepare his June budget, and he's assuming he's going to mow 500 lawns for the period. Okay? So he comes over and he prepares this budget, and he assumes that if he's going to mow 500 lawns and he charges $75 per lawn, his revenue should be $37,500, right? Easy enough. If what? If he has wages, and I guess he has some fixed wages of $5,000, I don't know, but he's got to pay an accountant to hang around and keep track of all this or something stupid, and he just tells the guy, hey, I'll pay you $5,000 a month, whatever. So he has that fixed expense. But then we start getting into some variable expenses, salaries and wages, and that's what he has to maybe pay each one of the workers that go and mow the lawns, right? Okay? Then what? And that's per lawn. Then what? Then he has these gasoline supplies, whatever, and that's all variable because if he doesn't mow a lawn, he doesn't, have to get gas for it, the supplies for it, equipment maintenance, I don't know, oil, grease, whatever it is for those. The actual work that somebody does is $3 per lawn. And then he has a bunch of what? A bunch of fixed costs here, right? Now notice the fixed costs aren't affected, of course, we know by the quantity, right? But he comes up with this total estimated spending, $32,500, and he thinks he's going to make $5,000. Now, this is a perfect measure against how he actually does, assuming he mows how many lawns? 500. If he mows what? 550 lawns, all of a sudden you take a look, and he's getting different numbers, and we start to say to ourselves, well, is he getting these different numbers because he mowed more lawns, or is he getting different numbers because he didn't pay the right prices here, right? Okay? So, what's happening? We received the right prices for the work that he's doing. For example, you notice he has more revenue, right? He has more revenue. But does he have more revenue because he mowed more lawns? Or does he have more revenue because he figured out some way to get some more money out of this deal? So, the price per lawn was what? $75? Okay, so $75 is the price per lawn. And he mowed how many lawns?
550.
550. What should his revenue be?
41,250.
41,250?
Yeah.
Okay. Is it?
No.
How much is it?
43.
It's 43,000. Well, how can that be if he's only supposed to charge $75 per lawn? What's going on here? So if you take this, what? This actual amount of 43,000, and you divide that by how many lawns did he actually mow? 550, you get what? You get 78, what, 18 or something like that? 78, 18? Well, he's actually not only mowing more lawns, he's charging more per lawn, isn't he? How's he doing that? Okay, we'll get to that. He'll be our expense guy. How about our revenue? How is he charging more fuel? How's he doing it? Is he going in and carefully changing each check to $78.18? Huh? How? Isn't Mr. Smith gonna say, "Hey, Larry, what's up with the 7818, buddy?" Huh? Okay. Oh, yeah, that's what you would tell the guy? Or he's getting the cash if the guy's giving the tip, right? Maybe what, huh? Okay. Like every lawn, don't you just like give the guy a box of candy? Can you just hand him a bottle of wine and say, "Here you go"? Somebody, don't you re-gift him a bottle of wine? And he can take it down the road to his next customer. And so on and so on. Until somebody drinks that wine. Maybe you're on the right track, right? I think you can probably figure out some things. Maybe what he does is he says, Mrs. Jones, your rose bushes can use a little extra, do you want me to get? And she looks and says, "Oh, thank you, Larry, that'll be wonderful," right? So Larry goes over and he trims up the bushes a little bit, and then she says, "Okay, how much more for that?" "Oh, just $3 for you, man," right? And he goes in. And so now we know that. We say, "Hey, Larry, or whoever did this, what'd you do? How'd you do?" "Oh, well, all you gotta do is you gotta mention the flower to them, and they're all over it. It's great, huh?" And all of a sudden, okay, it's a regular, standard routine when you go and you ask about this, even though I know you're only supposed to mow the lawn, but you do little sales while you're on site, right? But we were able to figure that out by what? We had to get behind and sort of analyze this one by dividing and saying, well, was it because we mowed more lawns, etc., right? And we're going to see in a couple of minutes that the flexible budget will call out precisely what's driving this, okay? Now, what was your name, sir? Solomon. You wanted to do the expenses, right? You saw some things in the expenses going on there, right? So, if he mowed 550 lawns, and his, let's just look at gasoline, because that was the one that was just purely variable, so it's a little easier for us to analyze that. And he's paying how much per lawn?
$30.
$30 per lawn?
Plus
Okay.
the initial $5.
For the gasoline?
Oh, for wages and salaries, not for gas.
How much? So it was $9 for gasoline and supplies, right? So if it's $9 for gasoline and supplies, and he mowed per lawn, and he mowed how many lawns? 550 lawns. So that should be what? $49.50. Is it? No, it's what? $5,100. Well, what's going on? Why is it $5,100 when it should have been $49.50 at this level of activity at 550? Huh? Price of gas changes, but you're always supposed to go to Rotten Robbie and they haven't changed the gas. We've been checking that all month. They didn't change the gas, and you're supposed to go. Did they have Rotten Robbie around here?
Yeah, we did many years ago.
Oh, okay. They got rid of that. Okay. We're not putting, premium gas in our, so the cheapest gas, right?
Well, since you're upselling something more, you use more of the supply.
Well, you mean because I'm doing more lawns, or because I'm trimming the
You're doing more work.
The rose bushes, you mean?
Yeah.
The rose bushes could be driving that to a certain extent, right? Okay, so now we're sitting there and we're saying, well, what, 5,100 is the amount, and if you divide that by how many lawns, 550? Huh? 550, how much is that per lawn? $9.27. So what's happening? We're incurring, let's say we get to the bottom of it, and that's correct. We're incurring 27 cents more per lawn, and the additional work that we're doing is generating what, $3.18 more revenue? So keep doing that, right? If we were upside down on that, the answer would be, Larry, just leave the quit asking her about the rose bushes. You know, you're costing us money, man. Now, what happens if we trim the rose bushes by hand? Huh? Yeah, but this is gas. We're not doing labor. This is gas and supplies. Huh? We said the lawns are about the same size.
If you're trimming the roses by hand, don't you still have to go buy the trimmer because you don't normally do that when you're mowing the lawn?
Oh, them trimmers, man, they're good for 8,000 rose bushes.
Well, yeah, but you still have to buy the initial trimmers because you don't have them when you're just mowing the lawn.
Oh, yeah. I'm driving the job here. I'm thinking maybe somebody, when they go to fill up the gas lawn mower, it goes in the tank, right? In their own tank. Okay, I'm a little low on that. Right? Maybe that's not something they're supposed to do or something. I don't know. But, and it could be what you're saying, okay? But notice, guys, we start doing what? Based on this, the point here is we start asking questions, don't we? And based on what we are learning from these questions, we're going to institute. And maybe it is. Okay, yeah, we got to, buy some more trimmers. That's fine. In fact, that's something that's going to occur even more because now we're going to all be trimming the lawns or something like that. But at least we know what it is per lawn, right? Okay. Now, the way I did this was very, unstructured, right? It's not a visual, it's not a presentation that everyone can sit there and look and say, I see what's going on, right? And so what we're going to see here is where we start doing this apples and oranges and we start showing favorable for our revenue. Well, of course it's favorable because what? Because we mowed more lawns, didn't we? Right? But we start showing for our wages and salaries these unfavorables, and we're like, well, are they unfavorable because we mowed more lawns and of course we're going to incur more cost? Or are we really spending more per lawn than we anticipated? Okay? So, this is still the undesirable format because it's apples and oranges. And so these guys are asking some of the questions that we were just asking. And so this guy comes in with the idea of a flexible budget. Okay? And so what happens? We're going to look and we're going to compare our actual cost to our flexible budgets to see what we come up with our revenue variances. And then where we're going to spend most of our time is on the spending variances. The revenue variance is just sort of, okay, our revenue increased. Great, if it's favorable, if it's unfavorable, how come? But most of our time is going to be spent on the spending variances, trying to understand what is driving the spending variance both from the standpoint of price and from a standpoint of the amount of input that's used. So we come over and let's take a look at his flexible budget now, which is apples to apples, and indeed the what? Now when we put it in at the actual level of activity versus our actual results versus our flexible budget now at the actual level of activity, so 5550 times 75 says that our budgeted price per lawn of 75, 550 lawn, our revenue should have been what? 41,250, right? You see how this is a flexible budget? So this is doing the same thing we just did up here on the board, but we're doing it now in a nice, easy to understand format, right? Sort of financial presentation format here, right? Then what? Then we go ahead and let's just look at the gasoline and supplies, they did the same thing we did over here, didn't they? But they just did it in a much cleaner, easier to analyze format. And so now you start looking over, and yeah, our what? Our revenue variance indeed is favorable, and we know it's favorable from the discussion we've had already because they're charging more per lawn. They figured out the rose bush situation, didn't they? And so we would be then saying, hey, that's a good thing. Go and talk more to more customers about doing the rose bushes, right? Because that was showing up favorable. Notice that the gasoline and supplies is unfavorable, and we know that it's unfavorable because what? We should have been spending $49.50 per lawn, and we were spending $5,100, weren't we? At that level of activity. So we know that there's something that's going on there that is falling outside of our expectations for that level of activity, and we start to get behind it because it's showing unfavorable. Why is it unfavorable? We ask the question, hey, we got to use more gas for the electric rose bushes trimmers? No. I mean, we got to use more gas for the gas-powered electric trimmers, whatever. And then what? We have to, or what? It's, hey, Larry's going home or whoever's going home and filling up their tank or something, right? Okay, but we get behind it that way. Okay? Question? Yes, sir.
Just activity fall, or and maybe there's more leads, so that means that gas powered mowers.
Maybe there's leads and they got to use the gas
That's why the gas is okay.
powered blowers more.
That's what it was.
Yeah, but he was doing, he used May as the month that he was driving off of, and this is June, right? So, but you're right, there certainly would be a seasonal adjustment, right? Beyond the scope, and that's completely off the range of what we're talking about. Well, not completely off the range, it's still counting, but very far from the range. There's a requirement that when companies report their seasonal, their quarterly activity, they need to disclose seasonal variances. So if you're a company like, one time I went to this place called Barbecue Galore, but I don't even know if they're in business anymore, to buy, I think I wanted some stainless steel spray, so I went to get a $4 can of spray, and when I walked out of there, I ended up spending like $10,000 on some outdoor barbecue thing or something. Now, if I go in there in December, I guarantee you I'm not walking out of there with a $10,000 barbecue. You walk in there on May 15th, when it's a beautiful day out there, and you picture yourself, so they would have to disclose when they're sitting there with their June quarterly financial report, or even their September quarterly financial report, they'd be required to disclose, look, this is a seasonal number, and we expect that the next quarter will be probably less than December quarterly report. Probably what happened? Well, no one buys barbecue chicken in September, right? If you're talking about Nordstrom, then they would probably have to disclose something else, right, for December, exactly. So you're right, and your instinct is right, that we would have to consider seasonal variations here, absolutely. Okay? Question? Okay. All right, so what I want to do is, I'm here to show you the spending variances here. I want to take the break right here. Well, not quite yet. Hang on one second. What I want to show you here on this slide right here is that we're going to be focusing more on the spending variance. What's causing the spending? The activity variance is we mowed more lawns. Okay, next, end of the analysis, right? Where we get much more information is when we take our flexible budget versus what? Versus the actual results. This middle column is the difference between the actual and the flexible budget. That's giving us our spending variances. That's where we're going to dig in. That's where we're going to be trying to understand, okay, is it price or is it the amount of inputs that are driving this, right? And once we know that,
Now we know, should we be talking to our production manager, who's in charge of controlling how much labor we use, or should we be talking to our, hiring manager who determines, what wages we're hiring people at, right? Maybe they're going nuts with overwork, or maybe our production manager is the problem with both of those, because what? He's using a lot of overtime. We're like, look, you can organize these shifts a little bit better so that you don't incur overtime every time on Friday when you realize you're not going to meet the week's level of output or something, whatever. Okay, and we can start to get to those kinds of analysis. All right? So, why don't we go ahead and stop there for the break, because I drank too much coffee this morning, more reason than anything. And we'll go ahead and we'll jump back and we'll get into some of those questions, and then we'll get into how we're actually going to be looking at these spending variances. With this example now, or not this example, we're pretty much done with that example, but let's go ahead and someone said that they were listening to the recording, and there's a wide range in the audio. Sometimes it's loud, and then other times it's quiet. That happens because the mic jumps up and down. So unfortunately, if you're watching those, you're going to have to kind of control the audio. And if YouTube transcribes it, you can maybe put it in the closed caption. Open that up. If they transcribe it, sometimes they transcribe it. Okay. All right, so make sure you're signing in, okay? All right, so let's go ahead then and let's take a look. And one of the things I'm doing in these couple of chapters now since the midterm is I'm picking more of these word questions, which have ended up being more of the challenge sometimes than the actual calculation questions, because we practice so much with those in class, you get real good at those, and then here comes one of these sort of stupid definition questions. And so I'm trying to put some more of those in, and typically I'll put those sort of in the slides, and then when we get to the calculation ones, I'm going to do those in the Word file. Anybody else need to sign in? Okay, good. So let's go ahead and let's take a look, and we say that based on a budget, based on several different levels of activity, often including both a best case and worst case scenario. I don't know about that. It could just simply be what? This is what we expect, and then we're going to compare it to the actual is going to be what? Is going to be considered a flexible budget. But it has different levels of outcomes versus on different levels of activity. Okay, good. Item A, company's flexible budget for 12,000 units of production showed total contribution margin of 24,000 and fixed costs of 16,000. Operating income expected the company produces and sells 15,000 units is, and I picked this up because I did see some questions in the exam where they were asking, which to me was more of a chapter 5 type of a thing, and yet they asked it on this second midterm that's not supposed to be comprehensive. So I grabbed one that was very, very similar, and notice that we're taking that contribution margin, we're dividing it by the number of units. That gives us a $2 per unit contribution margin. If our expected operating units is 15,000, that means our contribution margin is going to be 30 minus the fixed cost gives us the operating income, right? I mean, that's a contribution margin question more than a flexible budget question. Again, I don't know why they put it in this chapter. Okay, good. Let's come over then and let's take a look now at how we're going to deal with these spending variances. That's really where we are. We're going to sit here and analyze these spending variances and get behind the causes of them. Okay? So, we're going to take a look, and we're going to see that when we look at our spending, we're going to look at it in terms of both price and quantity of the inputs. Both price and quantity of the inputs. And we're literally going to sit there and go through each one of our factors, our product factors, which is going to be what? Our product cost, which is going to be direct materials, price, amount of materials, our what? Labor, rate for the labor is the price, the way they refer to the price for the labor, the number of hours, obviously, for labor, and then for overhead, it's going to be what? It's going to be our predetermined overhead rate, right, compared to what? Compared to our actual that we end up coming up with, and we're going to look at it for both the rate and the driver. And the driver in many of the questions is direct labor hours, although it could be machine hours or something like that, right? But whatever the driver is, okay? So we're going to do that for each, both price and what we're going to sort of generically refer to as price, and what we're going to generically refer to as quantity for each one of them, okay? So we come over and we see our going to come up with standard price and standard quantity. That's our budget. When we say standard, we mean the budget. That's the standard, okay? And we're going to want to see what are the variances from these standard prices, these standard quantities. Okay? When we're talking of that's for our materials. When we're talking about labor, it's going to be rate, which is going to be our amount per hour, $10 per hour, $15 per hour, whatever we pay, versus our actual. And then our standard hours for the number of units we produce, how much labor should we have used. Okay? And then we're going to look at it for our overhead, which is going to be our price, our standard, which is really going to be our predetermined manufacturing overhead, versus what we actually spent per driver, direct labor hour, whatever. And then what were the standard hours that we were supposed to use if it were direct labor hours was our driver versus our actual. Okay? Now this is what they call a standard job ticket, in which it talks about the cost that should be incurred for each job. Okay? So we have what? Materials, labor, and what? Overhead. We have the standard hours times the standard price or rate for each one of these gives us the standard cost per unit. That's called a standard cost ticket, and we're going to be comparing these to our actuals to see if we have a favorable or unfavorable variance. Okay? So you take a look at this question, and we have this janitor supplies produces industrial cleaning power that requires 40 grams of material at 10 cents per gram. Notice they pick up what? 10 cents per gram times 40 grams. Our standard cost for this is going to be $40, right? Then we go at $4, excuse me, thank you. Then we go ahead and we have what? 25.25 direct labor hours at $12 per hour. So we have what? Standard $3 for our labor costs. Overhead is assigned at $18 per hour times 0.25. That's going to be what? $4.50 for our overhead. Just picking the numbers up. So the standard is $11.50 that would show up on that job ticket. Okay? Okay, good. Okay, so let's go ahead and let's now get into our variance analysis. And now is the time to emerge from whatever sleepiness, come back. Yeah, let it go, because that was just sort of getting just sort of an overview. Now we're into, guys, this is what you got to take from this chapter. Okay, all the rest of this was just sort of, getting, preview, getting it loose. Okay, I got it now. Throw me the fastball, right? Okay, so now we're really getting into it right here. Okay, this is the takeaway for this chapter. This is going to be right here. The majority of questions on your midterm are focused right here. The ones that I've already put up on there are the ones that relate to what we talked about. Okay, and then the remainder of this material is going to be tested in the practice midterm. That we're going to start a couple questions here today, and you're going to finish them on your own. Okay, ready? Okay, so we come over and we first are going to go ahead and compute the direct materials price and quantity variances. Then we'll do it for labor, and then we'll do it for our variable portion of our manufacturing overhead. Now, I don't know if the school wants me to do this or not, and I don't care. Okay? I am going to put up on the board during your test the formula to help you calculate these variances. Okay? I don't care about you memorizing a formula to calculate a variance, please. And I am doing. Okay? So what we're going to do, unless they want to throw me out the window. Yeah, that's too far down even for me. So I'll go out the door. Okay, so what happens? We come over here and we have what? We have our materials. You don't have to write this down there. Well, you can. It won't hurt you. You don't have to, though. It's going to be on the slides in a minute. Okay, but I'm going to write it on the board, and it's up to you if you want to write it, and then I'm going to put it up on the board during the test. Okay? So we're going to have materials, and for materials we want what? We want price, and we want quantity variance. Right? Isn't that what would cause us to use too much or to have materials spend too much on materials or spend less than we thought would be? How much did you spend? Did you end up using quantity? And how much did you pay for it, right? And so if we can sit here and analyze which the causes of our variances, we're going to be much more better informed as a company to be able to figure out what we should do to correct that, right? Okay? And so what happens? When we take a look at the price variance, it's going to be the actual quantity, and we're going to multiply that times the standard price minus the actual price. Okay? What is it? Is that me? Maybe it's getting close to out of battery. Is that what it is? Yeah, it is. I just changed the battery. Maybe it's trying to tell me I'm too far away from the thing. Okay. So it's what? Standard price minus what? Actual price times the actual quantity. Okay? That's going to be my price variance. And if you think about it, guys, though you're not going to have to memorize that, but think about it. You want the price variance, don't you? So it makes sense to say, what was my standard price minus my actual? And if you want to measure the impact of the fact that you had a different price, then multiply that times what? Times the actual quantity. That's going to measure the impact of this price differential, isn't it? Okay? Now, we could also, for our quantity variance, we're going to go ahead and we're going to take the standard price and we're going to multiply that by standard quantity minus the actual quantity. Now, think about this. Again, I'm going to put it up on the board for the test, but think about this. If we want to get to our quantity variance, right, we have price variance and quantity variance. If we want to get to our quantity variance, it makes sense to do what? Take the standard quantity minus the actual quantity. That's going to measure the difference in our quantity, isn't it? And if we just want to isolate the effect of quantity, then multiply it times the what? Standard price, right? If you use the actual price, you got some price distortion in there, don't you? Okay? So this is the formula. I'm not going to make you memorize it, but these are the formula. And what we're going to practice, and what I'm going to have you drilling on, and you should start practice doing this in your homework right away when you start doing them, is I'm going to have you taking what I call the ninja approach to answering every single one of these questions, and that you're going to set them up just like this, and then you're simply going to plug in the numbers as you go about doing these, and these will become pretty easy questions for you. Get better and better at doing these, okay? So let's just go ahead and let's take a look at these examples in the book, okay? And we have these parkas that are being made. And notice, guys, I said you don't have to write down the formula because they're right here, okay? Which is what? Standard price variance is actual quantity times what? Standard price minus actual price. My quantity variance is standard price, standard quantity minus actual quantity. Now I've gone ahead and I've put in the abbreviations here for these, okay? So now they go ahead and they tell us that they have these outfitters and they have these material standard for these, what is it, parkas they're making, okay? And for the fiber fill in a mountain parka, we're supposed to use 0.1 kilogram of fiber fill per parka at $5 per kilogram. So they've given us what? They've given us the standard quantity. They've given us what? Standard price, right? Okay? You need to stay with me, guys. This is not the time to start, looking at your binder in a whole new way. Saying, gee, I never realized that the rings go round and round. Okay? You want to sit here and you want to pay attention to what we're talking about here. Okay? So what happens? We sit here and they tell us that last month they had 200 kilograms of fiber fill that they purchased and used to make 2,000 parkas. The materials cost a total of $1,029. Okay? So I should be able to go ahead and calculate now. Let's do the price variance first. Okay? So when I do the price variance, did they give me the actual quantity of the materials that they used? Kilograms?
Yeah.
Okay. Good. They used very good. They used 210 kilograms to make what? To make 2,000 parkas. Well, we're focusing on materials here, right? Not the units. So good. So can I go ahead and start the price over here? Do I have the first factor for price?
Yeah.
First factor for price is what? 210 kilograms?
Yeah.
Right? Okay. Okay, good. Now, I want to take standard price minus actual price. Do they give me the standard price? They give me the standard price is what? $5 per kilogram?
Yeah.
Right? So there's my standard price of $5. Am I just filling out the formula? $5 per kilogram? Okay, good. Now, do they give me the actual?
Not really.
They don't give it to me, but what? I certainly can calculate it easily enough, which they spent how much?
It's 4.9.
They spent $1,029, didn't they? On this stuff, is that the amount? They spent $1,029 and they purchased and used how many? 210, and you say that comes to 4.9?
Yeah.
So it's 490 per?
Mm-hmm.
Okay, good. So I've got what? I've got this 210 kilograms times, what is it, 10 cents per?
Mm-hmm.
So that gives me what, 21 would be even 21? Okay? Now is that favorable or unfavorable? That's favorable because what? Because my standard was what? More than my actual. So for whatever reason, they paid a little less for this fiber fill, didn't they? Okay? So the positive number will be favorable, won't it? Okay, so when you set these up, the way I talk about setting them up, there's a reason that I put the standard first. And you look, and I see a lot of material where they always, not materials like this material, teaching materials, where they want to put the standard second, and I'm always like, why? Now my students always have to sit there and think backwards, right? If you put the what? If you put the standard first, then what? Then if it's positive, it'll be what? It'll be favorable. If it's negative, you think of negative as what? Unfavorable, right? Okay, you can even use a face for that one if you want, like this, right? Negative is unfavorable, right? Okay? Okay, good. So we've got price. Can we do quantity? Again, I set these up the same way every time, guys. I work these like a machine when I work these. I set them up the same way every time. So I have to use what for quantity? I start with the standard price. Do you know what the standard price is? Standard price is $5. Okay, good. Then I go ahead and I have standard quantity. Did they give me the standard quantity? I'm kind of sitting there going, but I know they gave me what?
They gave you the 210 for the 2,000 carcass.
Wait a minute. Don't go too far off into the mountains yet.
Yeah, per
Okay, wait.
times 2,000.
Careful, scouts. Stay with the truth reader for a second. Okay, what I want you to do is I want you to take what's being given easily for this formula, right? So we know they gave me what? Actual quantity, didn't they? Did they give me actual quantity? So I go ahead, guys, and I stick in. I know that we're going to do it this way, but I stick in the actual quantity, which is 210? 210? Okay, good. So I'm just saying that so that free your mind, the other parts of your body will follow, right? And so what happens? There's a song that talks about the part of the body will follow. I don't want to say ignorance company, but you can figure out that if you're what? You free your mind, you're going to be able to figure out that next step, right? So now we're down to just the one thing that we have to calculate on this stupid thing, which is what? Well, it's the standard quantity. So now go ahead, guys. If I'm supposed to use what? I'm supposed to use 0.1 kilogram, right? 0.1 kilogram per what? Per parka. How many parkas did I make? I made 2,000 parkas. Good. So if I do the 2,000 parkas times the 0.1 kilogram, that's 200, isn't it? And so now I just do the math. $5 times the negative 10, what's that? Negative 50? And it is unfavorable, isn't it? Because I was supposed to only use 200 kilograms of this fiber fill material, and I used what? 210, didn't I? Right? Okay, so now we can even look at something more in this formula that I'm going to put up, and I'm not going to put up this part. If you think about it, the problems tend to give me everything but what? But the actual price, I had to do a little side calculation for, didn't I? And what? And the standard quantity, I had to do a little side calculation for. Everything else was just sort of laid out. Here you go. Right? Okay? So when I work problems like the ones you're going to see in your homework and stuff, what I do, guys, especially when we start getting into our sort of practice midterms and there's a bunch of questions that I know we're going to grind through and I have to hurry up and get ready for class and look at them, I sit here and I'm doing them just like this because I don't want to sit there all day on Sunday working questions, making mistakes and stuff. I want it quickly, bang, 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 done, you're done. I can go do something else, right? Okay, so that's the way you do them. That's the most efficient, effective way to do these. If you mess up and you don't get the right answer, you're quickly looking back up in your formula saying why, and you get to the bottom of it, right? So did we answer these? Did we answer these? Okay, so you take a look, and sure enough, there's the answers, right? It was what? 21, 21 favorable, and what? 50 unfavorable? Isn't that what we had? I only left all this in here to discourage you from reading the book and doing things that the book starts to get you into, where they start this, and here's how you derive the formula. And they start going in and deriving the formula. It's right there, guys. That's it. And I've explained the logic to you, right? So if you just plug in those numbers, you get those answers. Okay? Question? Okay, good. Well, this, I always kind of laugh at this, okay, because we're doing all this because we should be able to go over to the what? To the production manager and say, hey buddy, quit wasting all them materials. Well, what are you doing out there, right? And we should be going to the purchasing manager and saying, hey, Daddy, whatever his name is, nice job. You didn't spend that much, right? And look what happens. The guy says, well, I used too many materials because it's too much because we bought the cheap materials. So do you really get to the bottom of things with this? At least you know what? Well, we know that there's something going wrong here, and we've got to do what? We've got to dig maybe a little bit to get to the bottom, right? The only thing I don't like is she says your poor scheduling sometimes requires me to rush order materials at a higher price, but she paid a lesser. So I'm not sure what she's saying.
Well, she bought cheap material because he didn't give her enough time to find the good material at a cheaper price.
Well, then she should have paid a little more for the better stuff. She didn't give a very good answer, right? If I'm sitting there and I'm the boss and I'm like, well, Betty, I don't know why she looks like a Betty to me. I'm sitting there and I'm saying, well, why did you spend less? I mean, why did you do that? I mean, I understand that Bob over here, could do a little better job to get you more lead time, and we're going to work on him doing that. But the answer that you gave is ringing a little hollow for me because you paid less for the items, right? So at least Betty knows I'm listening, right? Okay? All right. Okay, so we come over then, and let's go ahead and let's try this one. And my buddy on this side of the room. I'm going to put this one over here, but I'm also going to ask for some help. So now we're going to practice the same thing with the materials for this Zippy company, or this, whatever the name, Hansen company is making up these Zippies. Who wants to try? You want to try one?
Alright, I'll do it.
You want to come up and do it?
I'll just.
You'll just do it for receipt?
Yeah.
Okay. Okay, that's fine.
So, you start with the price.
So you want to do the price first?
Yeah.
Okay. All right, that's your preference. You can do the price. We'll have someone else help you with the quantity. You want to do price and quantity?
It doesn't matter.
Okay, we'll start with price.
So the actual quantity was 1,000 zippies.
Okay, well, the Zippy is the product, so it's 1,700 pounds of materials, whatever the materials are.
1,700 pounds.
Right, so it's 1,700 pounds of material that they use. Good, so you got the standard, the actual quantity, now you're gonna take,
Standard price is $4 per pound.
standard price is $4 per pound, excellent. And now you gotta get the actual price, right?
And to get the actual, you have to divide 6,630.
6,630 is what they spent on these materials divided by,
1,700 pounds.
good, divided by the 1,700 pounds. Notice that 1,700 gets used twice in the price variance, doesn't it? It gets used as the actual quantity, and it gets used to figure out my actual price, right? Okay, so what do we got here?
3.9.
Huh?
3.9.
$3.10?
No, 90 cents.
90 cents? Okay. $3.90, so it's what, 1,700 pounds of material times a positive 0.10 gives me 170? Or, yeah, 170? Is that favorable or unfavorable? That's favorable because it's positive, right? All right, good. Is that the right answer? You say A? B, I mean? Huh? Oh, that's materials. Have to do some tap dancing. Right, for price? Okay, good. Good job. Okay, who wants to do, materials, and don't tell me 800? Okay. What's your name again, sir?
10.
Ken, you want to do this one?
Nope. $4.
I'm going to do quantity in red. Is that okay? You guys okay with quantity in red? Okay.
$4 is the standard price
So you're picking up that standard price of $4. Good.
times for 1,500 is the standard amount.
Okay, do me a favor, just so that we practice doing it this way. The way I like to do them is I like to pick up the numbers that are given, so I know I needed the actual quantity, so I just put it in. So now I'm down to the one thing that I need to do a little figuring on here, right? And so you're saying it's what, 1.5 pounds?
1.5 times 1,000, so 1,500.
Times 1,000 zippies,
Right,
so that gives us 1,500.
right.
Okay, of pounds for these zippies. And so that's going to be $4 times what, a negative 200?
Yes.
Not negative 2, yeah, negative 200.
800 unfavorable.
So that gives me 800 unfavorable.
Yes.
And I know it's unfavorable because it's negative, right?
Right.
Right?
Right.
Okay, good. Nice job. Okay, good. Okay, there's our materials. Let's do our labor. And let's just go ahead and put our labor formula up. Right here. I do that because I want to keep things honest. The one that does it right is the one that always gets selected. Okay, so we've got labor now, and for labor, our price variance, we call it a rate variance. But it's like a price, right? But we don't say, hey, what price are you going to pay me per hour? When someone's going to hire you, say, what rate are you going to pay me per hour, right? Okay? And so we're going to take what? But then, other than that, for our rate variance, it's going to be, we don't talk about quantity of labor, we talk about what? we talk about hours that are used, so it's going to be what? Actual hours, good, right? Actual hours. And it's going to be standard rate minus what? Minus the actual rate, isn't it? Okay? Okay, good. There's my rate variance. And if I want my, we don't say quantity of labor, we say usage. But it's just like the quantity, you know, the same principle for the quantity variance or that we use for our usage variance. And that's going to be, and we're going to have what? Standard, the standard rate. And we're going to multiply that times the difference between what? The standard hours, which is like our quantity, but we call it hours, minus what? Minus the actual hours, right? Okay? Okay, good. So let's go ahead and let's use this information then to do our labor. And Hans can help me with this one. Okay, so let's go ahead and let's do my rate right here for labor.
So, you set your hours, so, 2,500. So, 2,500 hours.
Okay, we use 2,500 for our labor now. We use 2,500 hours, you tell me?
Yes.
Okay. And I'm going to multiply that by standard rate is $10. Okay, good. And now I just need the what?
Actually, rate. So, we need a second equation.
I mean, not at standard hours, but standard rate. And I need to subtract that by what?
Actual rate.
Actual rate. How are you going to get me the actual rate?
So we're going to divide it by 2,000, 26,250.
Okay, good. The 26, so I'm going to do a little side calculation, right?
Yeah.
26,250, you're telling me?
Yep.
26,250 divided by,
2,000.
huh? What'd you say?
2,000. 1.2.
How many hours did they work?
25,000.
25,000 hours, right?
Yep.
So, huh? 2,500 hours, not 1,000. 2,500 hours, right? Okay, good. So it's 26,250 divided by what? The 2,500 hours, right? Okay, again, notice, guys, that what? The actual number of hours, the actual quantity gets used twice in this price and rate variance, right? And so we get what?
1.06.
Huh?
1.06.
We get what, 1050? We get 1050 as the difference, don't we? Where's the calculator? Throw it out with the what's that, a baby calculator? What's that, the Little Mermaid calculator you got there? Okay. So we got what? So we got what? We get then 2,500 times what? A negative 0.50? Gives me what? 1,250 is a negative? So it's what? Unfavorable, right? Good. Notice here, guys, just like it was for the materials price variance, the point of calculation was what? Was the actual rate, wasn't it? So that idea is to where most of the calculations come in, tracks down to the different types of variances, whether it's material, whether it's labor. Okay, good job. Who wants to do? Who from this table wants to do the rate? I mean, that was the usage. You want to do it? What's your name again? Huh? Beatrice, that's right. Beatrice? Did you say? Okay. Okay, so we are looking for what? The efficiency? Oh, I'm sorry, did we call it usage? I call it usage. Sorry. I should call it what? For, no, we already did rate, but for labor, it's efficiency. Sorry, guys, it's efficiency variance. That's the correct term for it, efficiency variance. Okay, so if you want to do the efficiency variance for labor, okay, Beatrice, you want to do this one? So my standard, do it in order of the formula, okay? You don't need two equal signs. So do we have a standard rate? Yeah, there's only one standard rate, and I'm going to use it for both the efficiency and the price, yeah. Okay, good, so it's going to be $10. And I'm going to multiply that by, do we have an, I know the standard we're going to have to calculate, do we have an actual hours? Good, actual hours is 2,500, so now we just got to figure out what the standard hours, right? For these, what? Number of parkas. How many parkas did they make? They made 2,000 parkas, good. How much were they supposed to spend per parka? How many hours per parka? How many per parka?
1.2 standard hours per month.
Good, 1.2 per parka. Can Omar help you with the math on that? You said it was what? Who's got
2,400.
2,400? Teachers? Okay, good. So it's what? It's $10 then, and it's what? That looks like a negative 100 again, right? Because we spent more hours for that number of parkas than we should have, right? So we got a negative, what, 1,000? And that is, Beatrice, favorable or unfavorable? Good. Favorable. We know that because it's negative, right? Well, yeah, I know. I get that sometimes. But the U looks like a happy face. That's why I reluctantly show you those. Oops, sorry. That's why I reluctantly show you those faces, because it does, right? The unfavorable, the U is unfavorable, right? So just look at the eyes. Oh, okay. We're good, Beatrice? Okay. Okay, good. And so there's the answer, right? 1,250, which is unfavorable, and what? 1,000, which is also, they're both unfavorable this time, right? Okay, good. I don't even know. Whatever. Okay? Sure what they argue. Whatever. you would have to sit there as a management. You're going to be so good with these formulas, you're going to have to play referee, aren't you? Right? So now we got to do one more, which is what? Oh, another zippy. So let me do my little, make this the zippy side of the room. So who wants to do this zippy?
No, what else for variance?
One time when I was a kid, I never wanted anything. And I went to my friend's birthday party, and I don't know what it was, I was on fire that day. I was pinning the tail on the donkey, I was dropping the clothespins in the milk bottle, I mean, I was just winning all the prizes. So what did they do? They came and took some of my prizes and things, and I never won. So the guy's dad gave me like a buck. Okay. He was a winner. Okay. More information than you need, right? I'm saying that because I'm like the guy's dad giving me bucks saying, you're too much on fire, kid. Who wants to try this? You want to try this one, Steve? Yeah. Okay. I'll let you do the next one. And then we're going to play with the drums.
Oh, actual hours, 15:50.
So which one are you doing?
Are we doing the rate variance first?
It's up to you. You want to do rate or you want to do efficiency?
Do rate first.
Okay, so we're going to go ahead and we're going to do rate. Okay, so we're doing rate variance. You want to take the actual hours they use, the 1550? Okay, so we'll take the actual hours, 1550. Good. Then what?
And then standard rate is 12.
Standard rate is $12. Good. They give that to us pretty easy, right? Okay, then you're going to have to do a little calculation for the actual rate, right?
Okay, you divide 18,910.
18,910 is their total spent.
Divided by 1550.
Divided by 1550 gives me per hour, colleague, please.
12.2.
12.2. Okay, good. So we've got 1550 times what? 0.20? Times 20 cents? Negative 20 cents, thank you. Negative 20 cents? So 1550 times negative 20 cents is what?
Negative 300.
Negative 300? So Steve, that is
Unfavorable.
unfavorable. Good. That's bad. Okay. Who wants to do this? Next, who wants to do the efficiency? You want to do the efficiency?
Sure.
Okay.
So we already have our 12 on the outside from the previous rate.
Okay, so when you say on the outside, you mean we're going to start with our
Yeah.
rate variance?
Yep.
Okay. I mean our standard rate, I should say.
Yeah, standard rate. And
Okay.
Then you subtract the 1550.
And then we're going to take off our actual, and then we're just going to have to calculate the standard, right?
Yeah. So then you just take the 1,000 of these
1,000 cities.
times, I think it's 1.5. So that comes up to 1,500.
Sorry, one second. Let me plug this stupid thing in before we lose it in the middle, and then we gotta reboot and all that nonsense. Okay. I'm sorry. So 1,000 times.
I think it's 1.5 standard hours for you.
Okay, we're back. Okay, so 1,000, and you say it's 1.5
Yeah, standard hours.
standard hours per zippy. Okay.
So that's 1,500.
1,500. So we should have used 1,500 hours, and we used 1,550, right?
Yeah.
So we've got a negative 50 times
12.
times the $12 standard price. That gives me what?
-600.
Negative 600. Good.
Which is unfavorable.
Which is unfavorable. Okay, good. Nice job. So we've got what? 310 unfavorable. That was our what? Huh? Can we get a different number up there?
Oh, and their calculation of what?
So 1550 left. Because you started with 1550.
Oh, and I put 1,500 here? Okay. So it's supposed to be what, 1,550 times negative 0.2 would have been negative 310?
Yeah.
Okay, sorry about that. So it's negative 310, 1,550 times negative 20 is negative 1,550? I mean negative 310? Okay, good. And I think this one's wrong, right? 600 unfavorable? Just checking our work here. Okay? Okay, good. Let's go ahead and let's do our overhead. Okay? Now, very important. We know that our materials are variable. We know that what? We know that our labor is variable, right? But when we got to overhead, there were some overhead like depreciation that were fixed, and some that were variable like our indirect labor, right? Right? Okay? So, how are you going to handle that? Can we control our fixed? Will our fixed change? Will our fixed change? Will our fixed change? Okay, so we're wasting our time doing a what? A variance analysis on the fixed. It is what it is, and it's not going to change, right? So we limit ourselves to just what? Analyzing the variable overhead portion, right? Okay? And so we're going to pick up just that variable rate per hour now, which is $4. This is not my predetermined manufacturing overhead rate, because that has what? Both fixed and variable components in it, right? We're dealing with just the variable part. And so when I go ahead and do my variable, and again, I'll put this actually, why waste ink, right? It's going to be the same for labor and what? Overhead, in which I'm going to have what? The rate variance is going to be the actual hours, and look, it doesn't have to be labor, whatever the driver is. Okay, so it could be machine hours, whatever, right? Okay, whatever the driver is, doesn't have to be labor. That says driver, whatever my driver is. And then for efficiency, it's going to be what? The standard rate, and it's going to be what? Standard, and I'm saying hours, and I'm just going to put down the driver, minus the actual hours, and I'm going to put down here the driver, right? Because it doesn't have to be labor hours, but for many, many of the questions we're going to see, you're going to use labor hours as the driver, okay? But it could be machine hours, whatever, right? Okay, so who wants to do this question? You want to try this one? Okay?
Okay, so you have your actual per rate there.
Okay.
You have your actual hours,
Actual hours,
which
which
is
is,
2,500.
okay, so we're using those same labor hours. So this company so happened to use labor hours as their driver, right? So we pick up the actual labor hours, 2,500, good.
Okay, and your standard rate is $4.
You pick up the standard rate of $4, And then we have to do the actual rate, which is what?
2,500. Or 2,000, which is,
No, 2,500 is the hours they work. How much was their overhead?
1050?
Their variable overhead was 10,500, right?
Yeah.
So that gives you, help please, 4 what? 420?
Yes.
4.20? Okay, good. So we've got what? We've got 2,500
Times the minus 20.
times the minus 20 gives us negative 500, and so it's unfavorable, right? Even though that looks happy, it's actually sad. Right?
Two to one.
They would be laughing and crying at the same time. Which is how you feel when you get out of business 101B. You're happy, but you're sad at the same time, right? Okay, good. All right, how about our efficiency variance here? Who wants to do that one? You want to do efficiency?
Yeah.
Okay.
So the standard rate is
Standard rate of what? $4
yes.
times
The actual hour is 2,500.
actual hours is 2,500. Good. You guys are right on target with the way you put these together. Good.
So you make 2,000 packets, so time 1.2.
2,000 parkas times, it's supposed to be 1.2 per, right?
Yes. So
We
it's
can really
2,500.
see that that's, since the drivers, the labor hours, the inside of the train, this is exactly the same we did before, right? Okay, good. But now we have what? Instead of using the labor rate, we're using our variable manufacturing overhead rate, right? Okay? And so that's what? $4 times a negative 100?
Yes.
$4 times a negative 100 is negative 400?
Yes.
That's
Unfavorable.
unfavorable. Good. Okay, good. Accounting 101B, right? That's what we're studying? Kush? Okay, good. Just want to make sure. Okay. Ken, you want to try the, well, let's look at the answer. You want to do the zippy one?
Sure.
For this one?
Sure.
Okay, we'll get zippies up there. We're just checking our work on that last one. Favorable, 500 unfavorable, and variable, rate variance, 500 unfavorable, efficiency variance, 400 unfavorable, right? Okay. All right, so here we go with the zippies. And, so what do you want, rate or efficiency?
We do efficiency.
You want to do efficiency? Okay.
So $3.
Huh?
$3 is the standard rate.
$3 is the standard variable manufacturing overhead rate, good?
And actual. What are we doing, right?
We're doing, what are we doing, efficiency? We're doing efficiency, so we want the actual hours, huh?
Okay. Actual hours was 1,550.
1550, good. And then we need to get the standard hours, right?
Standard is 1.5 times 1,000.
1.5 times 1,000 zippies, right? So what's that, 1,500? So that's a negative 50 times 3, right?
Negative 150. Unfavorable.
Negative 150 unfavorable. Good. Who wants to do the rate? that what we're doing now? Want to do the rate? Okay.
So it says, oh, you got 350.
So we want to start out with the actual hours, right?
Wait, oh, we're doing the actual hours.
Right.
Okay, so the actual hours are going to be 1550.
1550 times.
And the actual, so the standard rate minus actual rate, which is $3.
Standard rate is $3. Actual rate is, set it up for me.
Wait, I thought actual rate is $3.
Standard rate is $3.
Okay.
Huh? Okay, are we in agreement that the standard rate is $3?
Yes.
Okay, so I gotta put the standard first, right? Okay, and then we want to get the actual rate says what, sir?
330?
Where do you have to set it up for me, please?
No, 5,115.
5,115, like that?
Yeah, divided by 50 hours.
Divided by the 1550 hours, gives me what? I don't know, I'm not armed with a calculator right now, so 330?
Yeah, 330.
Okay, good. So we've got what? 1550 times a negative what? 0.30 gives me
465.
negative 465. Is that the answer? Okay. $465 negative, that must be what? My rate variance? My price variance is going to be what? The negative 150 that we calculated? Right? Okay, now, this is a subtle but important difference, okay? When you calculate the material's price variance, you use the amount of materials purchased because we're trying to measure what? The impact of our purchases for the period, aren't we? Okay? And in all the problems we looked at, they were consistent in saying that they purchased and used, but that's not really the way we deal with materials. We usually purchase one amount and then what? Use another amount, don't we? Especially like, remember those ones where we wanted to end up with some materials at the end of the period, whatever? Right? And so when you do the quantity variance, you clearly have to use then the amount what? Used. Okay? So when we look at our materials variances again, when we deal with the quantity, for the price variance, it's the quantity what? Quantity purchased. And if we're talking about what? If we're talking about our price variance is the quantity what? Purchase. When we're talking about our what? Quantity variance is the actual quantity what? Used. Versus the standard. It should be. Okay? Okay? So when we're talking about what? Price variance is the amount purchased. Quantity variance is the amount what? Amount used. Alright? Okay, so I think what I want to do is turn you loose on these. I was going to do some with you, but I'm thinking, you want to do one? We'll do one. Let's do one, and then I'm thinking it's probably better for you guys to go ahead and do these yourself. So let's go ahead and find one that we want to do, and this is from the practice quiz, whatever. What chapter are we in? 8?
Yeah.
Okay. I'll just do this one on here. I think I should get it to cooperate for one question. We saw some of these already, right? In the homework, in the slides, I mean. Okay, but I just want to do this one. Let's see if I do it this way. So we want to do the what? Materials quantity variance. Okay. And so when I do the quantity variance, I'm going to take what? Standard price. Who wants to set this up? Standard price is what? 1980 is the standard price. And I'm going to multiply that by what? Standard quantity minus the actual quantity. Do they give me the actual quantity? Do they give me the actual quantity? No, they're giving it to me. We rarely have to. Well, they want the quantity variance, so it has to be the amount that was used, right? So we pick up what? 5,100 was used, wasn't it? So it's 5,100 that got used is the subtract here, and is the amount that gets subtracted. So what goes over here? Words. Standard quantity that should have been used, right? Okay, good. So what was the standard quantity that should have been used? Omar, you got that? You don't have to give me the number, just tell me just how to set it up. Actual output, right, Ken, of 3,200 times, I'm supposed to use 1.7 meters, right? So 3,200 times 1.7 is 5440. 5440, like that, you say? Okay. So 5440 minus 5,100 is what? Positive 340? Okay, good. So 1980 times positive 340 is 6,732. Favorable? Is that the answer? Don't ever do it the way the book does. Don't ever do it that way. You can do it that way and come to your house and stop you from doing that. Don't do that. Okay? Question? Do them the same way every single time, every single one of these. And some of you that are just kind of absorbing this, be ready for action on Wednesday. You're going to be called on first to do them. Oh, make sure you signed in today. There was a roll sheet up here. Make sure you signed in. And where is the roll sheet? Oh, I got it. Yeah. Make sure you signed in. And we will probably get a start into chapter 9 next time, right? If you're doing the math, what we got, 9, 10, 11, and then we're gonna start practicing some more? Okay? All right, guys, make sure you sign in, please.